Can I welcome you to Lecture 6 in this series on banking and finance, the sort of lectures that will be given to undergraduates just starting a course in this particular area. I also apologise for the rather amateurish approach to recording. I have no idea what I'm doing, so it's fairly simple and fairly straightforward. It's all done in one take. I don't know how to pause or edit anything, so my apologies if any mistakes appear as I go along, but I'll do my best to keep them down to a minimum. This lecture is about a debate that has been going on for, a long way into the last century, about whether or not we should separate retail banking from other forms of banking. So we've had in 1933 the Glass-Steagall Act in the US. We've more recently had the Volcker Rule and the Vickers Report in the UK, all dealing with this particular issue. I've got a particular take on this, so my ending will be slightly different from most other people's, but then what else would you expect from me? So the title of the lecture is "Should Retail Banking be Separated from All Other Forms of Banking?" Now, before we proceed, again, there are some terms that will be used in this lecture and again in subsequent lectures, which I will define now so that you're quite clear on them. The first one, or the first two, is to separate the word speculation from gambling. You'd normally associate speculation with the stock market and gambling with horse racing, but that's not the way that you would define these two terms, because it's the actual action that is taking place, not what it is that you're gambling or speculating on. And speculation is just informed decision making, whereas gambling is uninformed decision making, just taking a punt on something, taking a guess on something with no information whatsoever. So it means you can speculate on horse racing, you can look at the form, you can look at the going, you can look at the weather, and you can go to the stables and see the horse and count the number of legs, make sure everything is all right for the race. That's speculating. It's an informed decision that you're making. Equally, you can go to the stock market and you can go, I like the name of that share. I used to have a dog I liked very much who had that name, so I'll buy that share. So uninformed decision is made where you've no idea what you're doing. You just pick a number or pick a name at random. So it's important that you recognise that in banking finance, you don't really want to get involved in gambling, but as we'll see, lots of people do. Another pairing of words that we want to separate is speculation, arbitrage. The difference between these two words is that speculation takes place over a period of time, after a passage of time, whereas arbitrage takes place at one point in time. Let me illustrate. If you're speculating on shares in the stock market, you would buy shares now, speculating that they would go up in value in the future, and then you'll be able to sell them and make your profit. Or you could sell shares now in anticipation of them going down in price in the future, and then you could buy them back at a lower price and make yourself a profit. So speculation requires the passage of time. Arbitrage, however, is different. Arbitrage is noticing different prices for the same product or the same item or the same asset in different parts of the world, different parts of the market, different parts of the country, and carrying out a sort of buy and sell order simultaneously. So you buy in the cheaper market, sell in the more expensive market. So as you can imagine, arbitrage is something which is very low risk, as long as you don't get it the wrong way around. You see two different prices and you buy the cheaper price and sell it at the more expensive price. And arbitrage was a way of making quite a lot of money in days gone by, go back 50 years, where communications around the world were very slow and where markets were closing. in one part of the world and opening in other parts of the world. So if you had access to information, arbitrage could make you a lot of money. Now, of course, with the internet and with the spread of information around the world so quickly, it's much more difficult, but not impossible, to make money from arbitrage. So just remember, if I refer to arbitrage, it's an action at one point in time, whereas speculation is something that takes place over a period of time. We have defined asymmetric information earlier in the course, but just a reminder because it will pop up again. Asymmetric information is where two parties to a contract have different levels of information. One party has more information than the other, and therefore that's possible that an unsatisfactory contract will occur between these two parties to the contract. So where information is not equally shared among both sides of a contract. Leveraging is a word that we are going to come across, and leveraging is basically borrowing money to do something. For example, if you had a pot of money and you were buying shares, selling shares with your own funds, then during a period of time when markets start to rise, and they carry on rising and they carry on rising, you say to yourself, I'm making so much money with my own funds, how much more money I would make if I could borrow somebody else's? And you might be tempted into leveraging, that is borrowing other people's money to carry on the process of making more and more money, which of course creates risks with it, because if markets suddenly turn down, if you lose your own funds, then you're marginally better off than if you lose other people's funds, because there you have a responsibility, a contract to repay that money or pay interest on that money, and it becomes much more difficult. So leveraging creates risk in your business because it means you're going to use somebody else's funds rather than your own funds to carry out actions. There is, and we're going to separate this a little bit later on, quite a lot of gambling that goes on now in financial markets. Spread betting, which used to be a sports bet, can now be used for share prices and for stock exchanges, where as long as you stay within the spread, then you're okay. But if you move outside the spread, then it may be to your benefit if it moves one way, or to your loss if it moves the other way. There are similar contracts for difference which take place whereby the buyer or the seller will make money if the difference goes one way or the other way. There are derivatives that we will mention. Derivatives have no value in themselves. They only have value because they are derived from an underlying asset which has value. So derivatives can be bought and sold, and certainly there is a price for those things, but all of their value comes from an underlying asset of one form or another. So you will find forwards and you will find options to buy things are all derivatives and all based upon buying and selling the underlying asset. Hedging is another word that we will come across, where hedging is protecting yourself a little bit about what might happen. It's, I suppose, an illustration in terms of derivatives. If you're in a situation where you're making money, you may want to hold on to that so you can make an equal and opposite purchase option, which will save you losing any money. Equally, you can put a stop loss whereby if prices go down, that they don't go down to zero. You know where you're stopping, and you know the point at which you're going to cash in your chips, if you like. So hedging is techniques which you would use to lock in a profit or not increase your exposure to a loss past a certain point. So all of those words may come into our conversation today and in subsequent lectures. Right, so our concern now is with retail banking and whether retail banking is different from all other forms of banking and therefore needs to be dealt with in a different way. The retail bank acts as a principal. I'm going to describe the retail bank as an intermediary. There are some economists who don't like that description of a retail bank. They prefer to think of retail banks as money creating businesses, whereas I have a little bit of an argument about that, but I don't totally disagree with it, as you'll see. But a retail bank is an intermediary between people who have savings and make deposits in the bank and people who borrow money from the bank. And as a principal, what it means is that if I make a deposit at a bank, my £1,000 at the bank nominally remains £1,000. And if my £1,000 is used to lend to people in risky ways, which causes a default, then that default won't come back to me because the bank takes the principal's position, and it will protect me against all potential risk in that area. My capital is protected, if you like. So the retail bank acts then as a principal. It accepts deposits from people and it makes loans to people. It makes loans to private individuals. It makes loans to small firms, small businesses. I've already described how retail banks started, or a story about how they might have started in the UK with goldsmiths who were originally depositories, but then realised there was much more money to be made by turning themselves into bank and lending out some of their gold, as long as people were happy to hold their receipts, their paper receipts, as gold. Then they found themselves in a position where they could make a lot more money being bankers than they would be just depositories. So the retail bank, if you like, has a long history going back several centuries as to what it is and what it does. It does lots of other things. It offers current accounts, which is just a money transmission account. It's now very big in the mortgage market. It wasn't back in the 70s and early 80s because there were building societies. Building societies accepted deposits and made loans only to people who were buying property, and banks couldn't do that. But when all things came together and banks were allowed to do building society business, and building societies decided they wanted some banking business, then lots of building societies converted into banks. A lot of banks offered competitive mortgage rates to get into that particular part of the market. So there are still some building societies around. Nationwide is one example, but there are a lot of old building societies that converted into banks. And as I say, banks, a lot of their business is now issuing loans for mortgages. The financial sector and the banking sector is involved in the issue of debit cards and credit cards. It offers personal financial advice. It was originally asset managed, that is, it looked at its assets to manage what its business was. The Bank of England told them to keep 8% of their assets in cash and 20% in other assets that could be turned into cash very quickly. It had a 28% liquidity ratio, and its assets were managed. But when that was removed in the 70s and we went to a different form of management, eligible reserve assets and eligible liabilities, they became liability managed. That is, they're more concerned about where they're going to borrow money from if required and how they will build up loan funds to themselves if business increases at a rate which was not quite anticipated or expected by them. So now we refer to retail banks as being liability managed rather than asset managed. Now that's the retail bank, quite clearly defined within that sector. But there's one other thing that it does which becomes a source of problems, and that is that it also creates new money. So the main source of money creation in an economy is a private bank issuing loans to its customers. Again, explained to you in a previous lecture. So it's an interesting point, because what you do is have banks carrying out business where, if they were inefficient and did it badly and made losses and went bankrupt, you'd say let them go. But because they're in part of the money creation process, if you do that, you're going to destroy some money which is being used throughout the economy to trade goods and services. You could bring about a monetary contraction, and that could bring about, if it was a large bank, some deflation and some problems in the economy. So I'm not a great fan of protecting anyone in a sort of capitalist economy. If you can't produce the cars people want, or the clothes people want to wear, or the food people want to eat, go out of business. Banks, it's slightly different, because if they go out of business, there's a knock-on effect in the way the economy's money is managed, because they are the main source of money creation. Now, it's not to say I would just let them off. If banks have difficult times, make losses, badly managed, make mistakes, then I'm quite happy for the Bank of England to jump in there and remove all of the top echelons of management and directors and give them some tender loving care, and then return them to the market under new management, if you like. So there's going to be costs of being an incompetent bank, but I wouldn't let it go bankrupt or liquidate, as this does have larger implications for the economy as a whole. But we'll again look at that a little bit more a little bit later on in this lecture. All the other banks, they're different. They don't accept deposits. And in this area we're talking about, sometimes it's described as wholesale banking. That's everything that's not retail banking. Sometimes it's referred to as investment banking. And this part of the banking sector is liability managed. It doesn't accept deposits. It may well assist high wealth individuals. It will work on behalf of companies, corporations, governments to help them raise finance. It will underwrite issues for initial public offerings by shares, by companies. If they're issuing shares, then the bank may underwrite that issue, which just means a form of insurance. We reckon at this price you'll sell this quantity of shares, and if you don't, we'll buy up the excess. In other words, we are your underwriter, your insurance against selling all your shares at the price that we all agree. They could also be involved in mergers and acquisitions, market making, trading and investing on behalf of their high wealth clients and companies, and they have become, over time, part of a conglomerate which has both a retail banking arm and a wholesale banking or investment banking arm. So they're involved throughout the banking sector, but they work as agents, not as principal, which means that they don't take risks in terms of taking someone else's money, doing something with it, and if they lose, they take the risk. They just bring together counterparties, if you like, and they, as an agent, take fees. So if they sort out mergers and acquisitions, then they take a fee for doing it. If they do underwriting, they take a fee for doing it. So they're not, this part of the banking sector is not acting as a principal, it's just acting as an agent, bringing parties together to carry out a particular type of business. Now, because of that, you can see the possibility for problems materializing in a conglomerate which has a retail banking sector and other banking sector involved, which is keeping information separate. Chinese walls, it's called, where you keep information separate between both parts of the organisation, or the many parts of the organisation, because information could leak from one to the other, which would then be prosecutable as insider trading if this information came out. So there's an attempt and a problem of trying to maintain Chinese walls between the investment arm of a banking conglomerate and the retail arm of a banking conglomerate. So we've got the investment banks, the wholesale banks, we've got the retail banks, we've got them separate in the past, coming together now. If you go right the way back to America, the Great Depression, straight after that the USA insisted that retail banks carry out only traditional banking business, and it was the investment banks that would deal in the capital markets. It was called the Glass-Steagall Act of Separation, and it was in place in the United States between 1933 and 1999, and it influenced similar divisions in Europe, but not actually quite the same. In fact, the UK, which had clear separation between building societies, retail banks, investment banks, and other financial banking companies, there was deregulation in 1986 which allowed these to come together. So a retail bank could buy an investment bank could buy a retail bank, and you found yourself in a situation where there were big conglomerate banks which had investment arms and retail arms, and there may be predominantly one sort of bank or the other sort of bank, but everything was going on within the one organisation. So if you looked at Barclays or HSBC or NatWest or any of the big banks, you would find that there were different arms to those banks. Now that creates and created a problem, in as much as there were lots of conflicts of interest under this system. If we just compared retail banking with investment banking, retail banking is relatively low risk. Lots of credit checks, lots of information provided. You may know how difficult it is if you go to your bank manager and say, can I have a loan? All the hoops you've got to jump through before you get that loan. It is a fairly low risk sector, whereas the investments banking side of the business is much higher risk. Now that could cause a problem if the high risk sector starts to make losses and covers those losses by the profits that are being made in the retail banking sector. So one sector of the conglomerate could put the other sector into difficulties, and that's a conflict of interest that materialised in the not too distant past. The government, in order to try and protect the retail banking sector from problems, runs a deposit guarantee scheme, which means as long as individuals have £85,000 or less in their accounts at one bank, then if that bank did liquidate, collapse, if anything happened with that bank, then the taxpayer, the government, would guarantee your deposit. So you will always get your money back. But that creates a conflict, because that creates a moral hazard. Because if the bank makes sure it informs all its customers who hold more than 85,000 and all of its other customers not to hold more than 85,000, otherwise it won't be protected, then the bank might feel that customer deposits are now protected, the government, the taxpayer is doing that, so we can actually do things that are a little bit more high risk. We can take more risk now, because with more risk there's more money to make. So let's do that. But of course with more risk there's the chance of making losses. And that's the moral hazard, if you like, that if you didn't offer that government deposit guarantee scheme, the whole conglomerate of this bank wouldn't take as much risk as it would take if you protected its depositors by this deposit guarantee scheme. You can find yourself in a situation where, with asymmetric information, the people who are looking after high wealth clients, people who want advice on how to use their money, won't have all the information that they need themselves, and there's a temptation, I mean, I'm sure this doesn't happen, there's a temptation from the investment banking side for advisors to want to encourage more trades because they get paid a fee for the number of trades you've got. So you don't really want someone on your book who's quite happy with what they've got now and never wants to buy or sell their shares that you hold on their behalf. You would like them to buy and sell quite a lot because that does mean more fees for you. So that produces a slight conflict of interest, what's best for the bank, what's best for the customer. You could also find yourself in a situation where these conglomerates have clients who are issuing things. So a client could be an initial public offering, an IPO of shares, and you could have investing clients, people who are looking for advice on where to put their money. And of course, the issuing clients will have information that the investing clients would very much like, but of course that would be insider trading and against the law. But you can imagine how tempting it might be, especially if you're going down the pub at the end of the week, talking to people in other parts of the business and looking for any scrap of information that might help to make you make a profit on Monday morning ahead of the rest of the people active in these markets. So again, you've got this conflict of interest where there are people within the same organisation pursuing different targets, and that is where Chinese walls comes in again, that you will be under strict instructions not to talk to, not to provide information, but we all know that after a few beers it becomes quite difficult to keep quiet about things, but I'm sure it doesn't happen. The other problem that I've often noticed, not so much in the UK, but it does happen certainly in the US, that it is bankers who become central bankers. So most central bankers around the world originally or at some point in time worked for Goldman Sachs, which gives Goldman Sachs just a little bit more of a network within the central banking sector than other banks would have. The UK is slightly different, although Mark Carney did work for Goldman Sachs at one point in the past. It's slightly different in as much as academics have usually made up, say, the Monetary Policy Committee of the Bank of England, rather than ex-bankers. But that's not usually the case, and it's certainly not the case in America. So bankers becoming central bankers can produce conflicts of interest as well. There's further problems where banks have a proprietary trading department. That is, the banks are trading on their own account as well as trading on behalf of other people's accounts. Because trading on your own account may encourage an investment bank into front running, into trying to act ahead of other people on information that's available. It may encourage you to climb over Chinese walls in search of proprietary information, mergers and acquisitions. They have time-sensitive information whereby if it's an acquisition, the company making the acquisition, its share price is likely to go down. The company being acquired, because new companies might come into the bidding process, their shares will go up. If you know that an acquisition is coming along, then you could act in a way that could benefit you. So there is this time-sensitive information that is available. And really what you want from your bank is someone who's going to benefit all customers and remunerate all employees. And some areas of proprietary trading, I would argue, doesn't do that and does create leveraging and risk where one trading department may borrow money from the other part of the bank in order to carry on what it considers to be a very profitable process, until of course it doesn't become as profitable as was expected. And the problem that you have there is quite often that within proprietary trading, if it's successful, the people doing the trading have nice big bonuses and there are big rewards. If it's unsuccessful, often other parts of the bank then get drawn in covering those losses, which, when you think about it, doesn't seem totally the right way to do things. Now, if we just look to the financial crisis of 2007 and 8, then again, this helps provide us with information about whether or not we would support a separation of retail banking from all other forms of banking. Lots of explanations of why it happened, but basically it was the collapse of mortgage-backed securities, the gambling that was taking place with regard to mortgage-backed securities. Big Short is a good film to watch, where you can get the idea of how you can get a build-up of bets on just one particular asset, and we'll find that there's one particular asset, shall we say, worth £1 million, and there could be, I was going to say £1 billion, I don't know whether they go that far, but why not, £1 billion of bets on what might happen to that one particular asset. So you can see there's a lot of money riding on the fact that that asset, if it goes up in price, is going to lose lots of people money, and it'll gain other people lots of money. So the mortgage-backed securities market and the securitization of assets was beginning to fall apart, particularly when people were gambling on what might happen to these assets into the future. Investment banks, they collapsed, so there was Bear Stearns and Lehman Brothers who went down. Merrill Lynch was taken over by the Bank of America, and again, whether this was banking and central banker information, I don't know, but Morgan Stanley and Goldman Sachs, they both changed their status from being investment banks in America to becoming retail banks, because retail banks had access to bailout money and investment banks didn't. I won't say anything else about that. At a similar time, in fact, just before the global financial crisis really hit, we had our own problem in the UK with Northern Rock, which was eventually nationalised. And again, I explain this in more detail on a previous lecture. And Northern Rock had a growth model which meant they grew very quickly, because they offered almost anyone who came in a mortgage. And when they became short of funds, they just bundled up some mortgages and sold them on to somebody, or securitized a bundle of mortgages, sold them on to someone else. The cash comes back into the company, and they can carry on lending and creating more and more loans. Some people considered that it was a bit unsustainable and high risk. And as the global financial crisis was building up, so Northern Rock found it more and more difficult to borrow money on the interbank market, where there was some mismatch between the money that they required and the securitization of assets that was going to provide that money. So they would just borrow in the interim to deal with that mismatch, but they had difficulty borrowing. So the Bank of England stepped in and lent, and then the Bank of England, being now a transparent organisation, told everyone about it. Everyone became worried, sort of queuing up outside Northern Rock, asking for their cash back, and of course they can't have it, because I think at that time Northern Rock probably only had 1% of all of its assets in cash, and so it was a forerunner in this country of what was about to come. And when the crisis hit, of course, it affected all the banks, and Royal Bank of Scotland, Lloyds TSB, they were partially nationalised and bailed out by the UK taxpayer. And the problem about being a retail bank manifested itself again. So we had the Vickers report, which came out in 2011, which stated that banks should be forced to ring-fence their high street banking activities and separate them from their investment banking arms. It didn't happen immediately, and things have moved quite slowly, but there was that recommendation then. There were other problems at that time. There was the LIBOR rate rigging scandal. There were exchange rate manipulations. There was people accused of providing privileged information to traders. There was more cases of insider dealing. So it was a period of time when there was quite a lot of disruption in the financial services sector. But it brings us back to our question: is the problem between retail banking and all other forms of banking, or is it between banking and casino banking? Obviously, we need to explain and define exactly what is meant by casino banking within this context. The Oxford English Dictionary definition of casino banking is the practice whereby a commercial bank engages in unduly speculative or risky financial activities with the aim of achieving high profits. Now, I would add to that definition because I would add proprietary trading in that definition. That is trading on your own book, which was often using privileged information, rewarding yourself if it went well, and distributing risk throughout the entire bank if things didn't quite go as well as expected. So I have my own thoughts about this, which is that we should work very hard to separate casino banking from all other forms of banking, not retail banking, but casino banking. The reason for this is that almost all banking business is relatively low risk. Investment banking, wholesale banking, retail banking, it's all relatively low risk. We've described the low risk in retail banking. Well, when you're acting as an agent in other forms of banking, advising private clients, advising on mergers and acquisitions, trading and savings accounts on behalf of your customers, that's all fairly low risk. The high risk is proprietary trading. So the high risk is in the area where traders are making decisions, making themselves lots of money, potentially losing lots of money as well. And what I would tend to want to do is to think about making casino banking totally separate as an organisation from all other banking. And I would actually make it illegal for a bank to trade on its own behalf, to have its own book. So, if you like, eliminate proprietary trading, which at the end of the day would then force the conglomerate banks to sell off their casino banking arm and set it up as a separate entity, which is fine by me, fine by them. They risk their own money and nobody else's money in their activities, and that will lower their risk when they're acting because they'll have no one to fall back on should they make losses. And the other thing is that if they make profits, then I'm not absolutely certain this is still the case, but I think it is, because trading is classed as gambling, there's no tax to be paid on gains. Whereas I would like the casino arms of banks, which are now separate independent entities, to be liable to tax and to pay their tax on their profits. But that's another point, and I'm not absolutely certain that that's still the case. But if it is, that's another advantage of separating the casino bank from the rest of the bank. Now, have there been sort of crises in banking as a result of casino banking? Because if there never has been a crisis, then we wouldn't really want to worry too much, will we? But yes, there has been. There have been lots of problems. Rogue trader. So you could read about Nick Leeson, couldn't you? His incompetence as a trader, carrying out rather a lot of gambles for Barings Bank, brought down the whole bank. So just one person's incompetence in proprietary trading brought down Barings Bank. Bear Stearns, Lehman Brothers, Citigroup, they were all gambling on underlying asset values, and things didn't go particularly well for them. So they were definitely banking crises caused by what we would describe as casino banking. LTCM, long-term capital market, is an interesting company that used a hedging scheme to protect itself against losses, and that hedging scheme was devised by Myron Scholes and Robert Merton. They actually received the Nobel Prize in 1997 for their new method to determine the value of derivatives, and they were also directors of the company in 1998, 1 year later, when it lost £4.6 billion and went into liquidation. Yes, you've had these problems with the Amaranth advisors. They lost £5 billion just on one trade before they collapsed in 2006. There were other problems at the time, but these ones weren't down to casino banking. BCCI, they went out of business, but theirs was a money laundering financial crime. The government-sponsored enterprises, Fannie Mae and Freddie Mac, got caught up in buying mortgages that were sold to people who couldn't afford them. So they found themselves in a very difficult situation at about the time of the global financial crisis, and were, of course, all part of it. Northern Rock, they were unlucky because although their model was pretty aggressive as a growth model, they didn't actually have many bad assets on their book, but they did need the tender loving care of the Bank of England, which unfortunately spilled over to the Bank of England, telling everybody about their problems and frightening them into wanting to get their money back from Northern Rock in the form of cash when Northern Rock couldn't do it. The RBS, Lloyds TSB, they were collateral damage from 2006-07, and they were bailed out, but their problem wasn't one associated with the casino banking problem. Now, the USA has resolved its problem in as much as in 2010 the Volcker Rule was passed, which prohibited its retail banks from proprietary trading, the casino banking, therefore separating the liabilities of low-risk banking from that of high-risk banking. So the Volcker Rule we will take as being a successful way in the US of dealing with it. We haven't quite gone that far, although the Vickers report did say that banks should be ring-fenced. And they're still talking. I think the Vickers report got it wrong. So what would I say? I would say yes, because it's totally different, retail banking, from all other forms of banking, because it has its finger on this money creation sector, that you need to separate retail banking from casino banking. But I would allow all other forms of wholesale banking to work alongside retail banking in the same bank. I see no problem whatsoever in low-risk retail banking and low-risk mergers and acquisitions and advice and information that would be provided in the other banking sector. They can all work together. As far as I'm concerned, that is all low risk. And all you need to do is set up casino banking or proprietary trading as a separate business, remove it from the banking sector as such. So my solution, if you like, to the question, should we separate retail banking from all other banking, is no. Let's take casino banking out of all banking and leave retail, investment banking, wholesale banking all in the same conglomerate. I have no problems with that at all. So that's my answer. Not necessarily the answer that you would all agree with, but that's great because you've got to think about what I say. Argue among yourselves, argue with me, point out all the things that I've got wrong, and then we'll be a little bit further down the line of solving, hopefully, some of the conflicts and the issues that come out of the banking sector under current circumstances. I hope you've enjoyed that, and I suspect we'll be on to derivatives in the next lecture, but don't hold me to that promise. There may be something that comes before that, but thank you for being with me in this lecture.